Right now, a silent collision is happening between the Middle East and the Federal Reserve, and it is setting up an economic trap that could wipe out a decade of your wealth in a matter of months. We are not just talking about a normal market correction or a temporary dip. We are looking down the barrel of a 1970s-style stagflation crisis. This is the exact scenario that billionaires and institutional insiders are quietly preparing for, while the retail crowd is left completely in the dark. Today, we are going to break down the exact geopolitical risk stagflation, investing strategy that you need to survive and thrive in this chaos. We are going to look at the escalating tensions between the United States and Iran. We are going to examine the terrifying warnings from top economists about an impending oil shock. And most importantly, we are going to give you the exact playbook to protect your money right now. Let us start by looking at the geopolitical tinderbox that is currently smoking in the Middle East. Recently, we saw a massive escalation in tensions between the United States and Iran. This was not just political posturing or angry speeches at the United Nations. We saw reports of a direct cyber attack on the personal email of a senior official from the Federal Bureau of Investigation. This alleged hack by Iran-linked actors is a massive wake-up call. It shows that modern warfare is no longer just about tanks rolling across borders or fighter jets in the sky. Modern warfare is fought in the digital trenches. It is fought in the servers and the power grids and the financial networks that keep our entire civilization running. When a foreign adversary can reach out and touch a high-ranking domestic intelligence officer, it sends a chilling message to the entire global market. This is a direct state-linked hostile act. It is a massive escalation that the mainstream media is largely brushing off as just another news story. But smart money knows better. They see this as the first domino, falling in a very long and very dangerous chain reaction. Now we need to talk about Nouriel Roubini and the ghost of the 1970s. If you do not know who Nouriel Roubini is, you need to pay very close attention. He is a prominent economist who earned the nickname Dr. Doom for a very good reason. Back in the mid-2000s, when everyone was getting rich, flipping houses and taking out massive mortgages, Roubini stood up and warned that the entire system was a house of cards. He predicted the 2008 financial crisis with terrifying accuracy. People laughed at him until the global economy collapsed. Now Dr. Doom is sounding the alarm again, but this time he is not warning about subprime mortgages. He is warning about a structural return to the 1970s. To understand why this is so terrifying, we need to take a history lesson. Imagine the year 1973. The Yom Kippur War breaks out in the Middle East. In response to Western support for Israel, the Arab oil-producing nations launch a massive oil embargo. They simply turn off the taps. Overnight, the global supply of crude oil is slashed. The price of energy skyrockets. This was not just a minor inconvenience. This was a catastrophic shock to the entire global system. People in the United States were suddenly waiting in their cars for hours in lines that stretched for miles, just to buy a few gallons of gasoline. Gas stations ran out of fuel. Fights broke out at the pumps. The entire economy, which relied on cheap energy to function, suddenly hit a brick wall. But it was not just the lack of fuel that caused the pain. The massive spike in energy prices bled into absolutely everything. Oil is not just used for cars. It is used to make the plastic in your television. It is used to transport the food to your grocery store. It is used to manufacture the fertilizer that grows the wheat that makes your bread. When the price of oil doubles, the price of everything else goes up with it. This creates a massive wave of inflation that sweeps across the entire country. Savings accounts are decimated as the purchasing power of the dollar evaporates. This is exactly the kind of supply shock that Nouriel Roubini is warning about today. If the conflict with Iran spirals out of control, this brings us to the most dangerous word in the English language when it comes to economics: stagflation. This is the trap we are currently walking into. To understand stagflation, I want you to imagine that you own a small local bakery. You wake up early every morning to bake fresh bread for your neighborhood. One day you wake up and turn on the news. There is a massive war on the other side of the planet. Because of this war, the cost of the fuel you use to heat your ovens has completely doubled. The cost of the wheat you use to make your flour has tripled. Your business expenses have gone through the roof overnight. You are bleeding money. To survive, you have absolutely no choice but to double the price of your bread. But here is the nightmare scenario. At the exact same time you raise your prices, the massive car factory down the street from your bakery suddenly goes bankrupt because of the bad economy. Thousands of your regular customers lose their jobs in a single afternoon. Now you have a bakery full of extremely expensive bread, and a neighborhood full of people who have absolutely no money to buy it. You cannot lower your prices because your costs are too high. You cannot sell your bread because your customers are broke. You are stuck in a state of economic paralysis. That is stagflation. It is a toxic combination of high inflation, where everything costs more, and stagnant economic growth where people are losing their jobs. It is an economic disease that is incredibly difficult to cure, and the only doctors who can try to cure this disease are the people sitting at the Federal Reserve. The Federal Reserve is the central bank of the United States. They control the money supply. They have a steering wheel that controls the entire economy. That steering wheel is called the interest rate. When the economy is weak, they lower interest rates to make borrowing money cheap. This encourages people to buy houses and start businesses. It is like stepping on the gas pedal. When inflation is too high, they raise interest rates to make borrowing expensive. This slows down spending and cools off prices. It is like stepping on the brakes. But stagflation completely breaks the Federal Reserve. It forces them into an impossible choice. If they lower interest rates to help the people who lost their jobs, they will flood the system with more money. This will cause the already high prices of food and gas to explode even higher. They will destroy the currency. But if they raise interest rates to fight the high prices, they will make borrowing so expensive that thousands of businesses will go bankrupt. They will cause a massive recession. They are trapped between a rock and a hard place. And this is where a figure like Kevin Warsh comes into the picture. Kevin Warsh is a name that strikes fear into the hearts of Wall Street traders. He is a former Federal Reserve governor who is known for being incredibly hawkish. In the world of economics, you have doves and you have hawks. Doves are gentle. They want to keep interest rates low to make everyone feel good, even if it causes a little bit of inflation. Hawks are aggressive. Like a bird of prey, they want to hunt down and kill inflation at all costs. They do not care if the stock market crashes. They do not care if unemployment spikes. Their only mission is to protect the value of the currency. If someone like Kevin Warsh gains influence at the Federal Reserve during an Iran-driven oil shock, we are going to see a brutal return to the policies of the 1980s. Back then, the Federal Reserve was run by a giant of a man named Paul Volcker. Paul Volcker looked at the rampant double-digit inflation, destroying the American middle class, and he decided to end it. He raised interest rates to an absolutely mind-boggling 20%. Imagine trying to buy a house with a 20% mortgage. Imagine trying to get a loan for your small business at 20% interest. It was financially devastating. Farmers drove their tractors to Washington to protest outside his office because they were going bankrupt. Construction workers mailed him wooden 2x4s because no one was building houses anymore. It was immense economic pain, but it worked. It killed the inflation dragon. The warning in our strategy today is that a hawkish Fed facing a geopolitical oil shock will not hesitate to unleash that exact same pain on us again. Yet the vast majority of regular investors are completely blind to this danger. They are suffering from a psychological condition called herd bias. They are simply following the crowd. For the last 15 years since the crash of 2008, the herd has been conditioned to believe that the stock market only goes up. We have lived in a magical fantasy world of 0%. Interest rates and endless money printing. Every time there was a geopolitical flare-up or a scary news headline, the market would drop for a few days. Then the Federal Reserve would swoop in like a superhero, print billions of dollars, and push the stock market to new record highs. The herd has become just like Pavlov's dogs. Remember the famous science experiment. The scientist rang a bell and then fed the dogs. Eventually, the dogs learned to drool just from hearing the bell, even if there was no food. Modern investors are drooling every time the market dips. They hear a scary headline about a war, and they immediately open their brokerage apps to buy the dip. They think every crisis is just a temporary discount. They are completely failing to realize that the underlying machinery of the world has fundamentally broken down. A 1970s-style energy shock is a completely different beast. You cannot fix a massive shortage of physical oil by printing digital money. On a computer screen, the herd is fighting the last war. They are expecting a quick and easy recovery, while the very ground beneath their feet is opening up to swallow them whole. We can already see the cracks forming in the domestic foundation of the country. Look at the recent disruptions with the Transportation Security Administration. We are seeing reports of pay disruptions for the TSA workers who secure our airports. On the surface, this might seem like a minor administrative glitch, but to a macroeconomic strategist, it is a terrifying red flag. It is a symptom of severe domestic political friction. It shows a government that is struggling with internal instability and a lack of basic operational capacity. If the government cannot smoothly execute the basic task of paying its own security personnel during a time of relative peace, how on earth are they going to manage a massive multi-front crisis involving a war in the Middle East, a global oil shock, and a crashing stock market all at the same time? This internal fragility deeply erodes investor confidence. It proves that there is no adult in the room coming to save us. To navigate this chaos, we must think completely differently. We must abandon the herd and adopt a contrarian mindset. Smart money does not just react to the news. Smart money traces the deep hidden consequences of the news. They look at the world through the lens of first, second, and third order effects. Let me explain this with a simple analogy. Imagine you are standing a bunch of dominoes up in a line. The first order effect is simply pushing the first domino. In our current world, the first order effect is the escalating drumbeat of war. With Iran and the linked cyber attacks, the immediate reaction is that fear floods the market. The stock market gets volatile. People panic and buy safe assets, and the price of crude oil starts to climb, because everyone is terrified that the oil ships in the Middle East will be attacked. That is the first domino falling. Most people stop thinking right there. But the contrarian looks at the second-order consequence. What happens when that first domino knocks over the next one? The second-order consequence is that these high oil prices do not just go away. They stay high. And because oil is the lifeblood of the global economy, those high costs embed themselves deeply into the price of everything else. Inflation becomes incredibly sticky. It refuses to go down. This forces the Federal Reserve to panic. They realize their gentle approach is failing. So they bring out the heavy artillery. They hike interest rates much faster, and much higher than anyone on Wall Street currently expects. They deliberately slam the brakes on the economy to destroy consumer demand. Then comes the third-order opportunity. This is where the massive wealth transfer happens. The third domino falls. The resulting stagflationary environment becomes absolute poison for regular stocks. Broad equity indexes like the S&P 500 get crushed. Growth stocks and technology companies that rely on cheap money see their valuations wiped out. But while the herd is losing their life savings, the contrarian investor is making a fortune. The contrarian has already positioned their money in the very assets that thrive in this toxic environment. They have bought energy producers who are making record profits from the high oil prices. They have bought real physical assets like gold that protect their purchasing power. When paper money is burning, they have bought companies that have true pricing power. This brings us to the ultimate generational bargain. Right now, fear is becoming the dominant emotion in the market. But a rational strategist uses fear as a compass, not as a master. The news flow from the cyber attacks to Nouriel Roubini. Stark warnings is a massive 5-alarm fire warning you to stop being complacent. During times like this, we must look to the greatest investors in history for guidance. Let us look at Warren Buffett. Right now, Warren Buffett is sitting on a massive mountain of cash. He has hundreds of billions of dollars, just sitting there doing absolutely nothing. Why? Because he knows that cash is not trash. Cash is a call option on every single asset in the world, with no expiration date. He is waiting for the fat pitch. In baseball, you do not have to swing at every ball the pitcher throws. You can stand at the plate and watch pitch after pitch go by, until you see the perfect one right down the middle. Buffett is watching the panic build. He is waiting for the moment when the market completely breaks and excellent companies are selling for pennies on the dollar. He is checking his climbing gear, while everyone else is running blindly for the hills. We also have to remember the incredible story of John Templeton. John Templeton was a legendary investor who made his fortune by stepping into the fire when everyone else was running away. It was the year 1939. The world was plunging into the darkest period of modern history. World War II had just begun. Hitler had invaded Poland. Panic gripped the entire globe. The stock market was in a state of absolute free fall. People were terrified that civilization itself was ending. But John Templeton did the exact opposite of what human nature told him to do. He went to his broker and borrowed money. He then placed an order to buy 100 shares of every single company, trading on the New York Stock Exchange that cost less than $1 per share. He bought into the absolute maximum point of global pessimism. He bought the companies that were closest to bankruptcy, And when the dust settled and the world rebuilt, he became phenomenally wealthy. We are not at that point of maximum pessimism yet. The current market jitters are just the tremors before the massive earthquake. But you must be ready. So how exactly do you prepare for this earthquake? You use the 50-35-15 seesaw asset allocation model. This is your survival bunker. We divide your portfolio into 3 distinct buckets. The first bucket is the 50% stock allocation. But this is not just blindly buying the whole market. You hold a core position in strong broad market funds. But you absolutely must add a tactical heavy position in the energy sector. You buy the companies that pull the oil out of the ground. When Iran shuts down the straits and the oil price goes to the moon, these companies will see their profits explode. They are your direct insurance policy against the Rubini oil shock. You also buy defensive healthcare stocks. No matter how bad the economy gets, people still get sick. They still need medicine. Healthcare companies have the immense pricing power to survive stagflation. The second bucket is the 35% safe haven allocation. This is your shield wall. Half of this should be in intermediate term. United States Treasury bonds to provide a bedrock of stability. The other half must be in physical gold. Gold is the ultimate monetary insurance policy. For over 5,000 years, gold has been the only true money. Fiat currencies like the dollar and the euro always eventually lose their value to inflation. But gold cannot be printed by a central bank. It cannot be hacked by an Iranian cyber team. When the financial system loses its mind, capital always flows back to the shiny yellow metal. It is the ultimate hedge against currency debasement and geopolitical turmoil. The final bucket is the 15% cash reserve. This is elevated far above normal levels. This cash is not dead weight. It is your strategic shock absorption mechanism. When the geopolitical flare-up happens, and the market drops 10% in a single day, you do not panic. You simply deploy your cash and buy incredible assets at a massive discount. You might be wondering why we still rely so heavily on United States assets. If the government is fractured and the inflation is high, it is because of the global shield concept. The United States dollar and the American financial markets are what we call the cleanest dirty shirt in the laundry basket. Imagine you have to go to a very important meeting, but all your clothes are dirty. You dig through the basket to find the shirt with the fewest stains. The entire global economy is a basket of dirty shirts right now. Europe is facing massive energy shortages and economic stagnation. China is dealing with a collapsing real estate market and severe demographic issues. Emerging markets will be absolutely crushed by the twin hammers of a strong dollar and expensive oil. So when global panic sets in, all the money in the world flees back to the United States. Even though the inflation is bad here, the liquidity and safety of the American system is still unparalleled. It is a painful dynamic, but it is reality. Finally, you must master survival mechanics. Standard investing advice tells you to dollar cost average, to just blindly put the same amount of money into the market every single month, regardless of what the news says. That is suicide in a stagflationary geopolitical crisis. You must upgrade to crisis dollar cost averaging. You keep your normal investments going, but you absolutely refuse to use your 15% cash reserve on minor little dips. Do not buy a 3% drop because of a bad jobs report. You hoard that cash until a massive news-driven dislocation happens. You wait for the bombs to fall, or the oil to spike and the market to truly bleed, and you must ruthlessly enforce the 50% rule. If you make a tactical bet on a specific stock or a niche fund, and it drops 50% from your purchase price, you must immediately sell half of it. No questions asked. You do not hold on and pray for it to come back. This is not admitting defeat. It is a disciplined military tactic to prevent a total catastrophic loss. It forces you to pause, step back, and reevaluate if your fundamental thesis is completely broken. In a world, this volatile stubbornness will destroy your wealth faster than any market crash. This is not a time for blind prediction. It is a time for brutal calculated preparation. You must build a fortress portfolio designed from the ground up to withstand the massive collision of Middle Eastern geopolitics and Federal Reserve monetary policy. The warning signs are flashing bright red. Do not ignore them.